Chapter 7 by Pullbacks and Breakouts? With an understanding of how a trend's rate of movement changes, we can now examine two popular strategies, buying a breakout and buying a pullback. A couple of simple adjustments to the general pullback and breakout trade strategies will make these strategies much more profitable. Of course, the improvements to these strategies come from the addition of AVWAP analysis. Pullbacks. The nature of markets is that they experience a directional thrust and then either consolidate sideways through time, meaning that the price stabilizes and stays within a somewhat narrow range, or they experience some short-term profit-taking, which creates a pullback. A pullback is also often referred to as a dip. One of the basic foundations of technical analysis is that a trend, once established, is more likely to continue than reverse. Because of this fundamental rule, it's important to study pullbacks carefully. After any period of frenzied trading, calmer heads need to prevail. Recall what we learned in Part 2, Chapter 2 about support and resistance. Each is only identified with certainty in hindsight. Pullbacks are akin to this. We give a pullback the benefit of the doubt and prepare a purchase, but if it continues to decline in price, we do not participate. The reemergence of trend on the shorter time frame is our opportunity to take part in a low-risk, high-probability trend continuation trade. This is the basis of trend alignment. When the trend on the longer time frame is still intact, we should treat pullbacks as innocent until proven guilty. However, if the pullback continues to a point where the longer time frame no longer exhibits a pattern of higher highs and higher lows, we should abandon the setup until it aligns on multiple time frames. Don't buy the dip. We often hear buy the dip as a strategy to purchase a stock. This refers to the desire to buy a stock that is in a longer-term uptrend, as it experiences a near-term price correction, a pullback. It makes sense to want to buy the dip. We want to pay less than the recent high. Trading activity corrects the strong momentum, then pauses, and can then either turn back higher or fail. The possibility of trend failure is why we do not blindly buy on a pullback. Buy strength after the dip instead. We want to anticipate what is most likely to happen next to the stock and create our trade plan as its price drops to a level of interest. We wait for price momentum to confirm that the selling has subsided. Then, when buyers regain control of the short-term trend, we take part in the emergent strength, i.e., the price movement upward. This is the essence of trend alignment. We want to buy as the stock moves back up above the AVWAP from the prior high. It tells us with absolute certainty that buyers have taken back control from the prior high point. We do not have to guess. When the price is above the AVWAP from the recent peak, it means the average buyer from that point is now in a profitable trade. Also, the average short seller will be in a position of weakness as their average sale price is below the current level. There is no technical tool better than AVWAP to identify the transition of power from buyers to sellers and sellers to buyers. Let others pave the way and create a near-term level of support before you purchase strength after a pullback. Imagine you are at the beach and there's a group of people standing on top of a cliff peering over the water, tentatively deciding whether to jump into the refreshing water 40 feet below. No one has jumped from this cliff before. As a thrill seeker, it might tempt you to jump, but do you want to be the first to make the leap? What if there is a rock just below the surface that you cannot see? Of course, no one should jump if it is unsafe, but if you are going to go, don't you want to make sure that no one gets hurt before you do? Let others take the big risk. Use a smarter approach to risks in the markets and in life. Chart 7.1 shows why we do not blindly buy a dip in an uptrend. There were 3 dips in this stock's strong uptrend. The first dip, 1, saw the stock drop from $29.20 to $22.60, a 22.6% drop in 3 hours. Imagine how you would feel if you bought the pullback, such as when the stock was $28, $27, $26, $25 and the stock continued down to $22. The second dip, 2, saw a smaller decline from $29.50 to $26.77, just 9.3% in an hour and a half. The third dip, 3 saw the stock drop close to 50% in just 6 days. If instead of buying on weakness, you waited until the stock got back above the AVWAP from the prior peak, one of the green dots, you would have made your purchase when buyers controlled the trend. Notice there is no green dot after the peak at $34. The stock never got back above the red AVWAP from that peak, so no purchase would occur. Rather than give in to emotional thoughts like, "It's down too much," a disciplined approach would have kept a buyer from buying as it declined from $34 all the way down to $17 and taking a large loss. You will never buy at the low when you buy on strength, but you will avoid unnecessary losses and you will have a logical place to set your stop. Not all dips end up being a simple pullback. They can represent trend failure, which is why we wait to buy strength after the dip. Do not buy stocks in downtrends as we see in the chart 7.2, when the 50 DMA is sloped lower, the weakness is not a dip. It is a stock in a downtrend and it should not be considered for a long position. Many people try to buy a dip in a stock in a downtrend. That is simply wrong. It is not a dip purchase if the stock is in a downtrend. It is buying a stock that is more likely to continue lower than it is to reverse. The accumulation process, stage 1, seen on the market structure chart, can take months or even years before the stock is ready to turn higher again. If the collective action of buyers and sellers don't scare you out in the decline phase, they will wear you out in the long accumulation process. Don't waste your time and money buying stocks in downtrends, no matter how low the price is relative to recent history. Don't let FOMO rule your decisions. Wait for buyers to re-establish control before you participate in the trend. Many traders give in to the temptation to buy a stock in the decline phase, which is a type of FOMO. They see the stock rally from a certain previous level and cannot stand being on the sidelines as it reaches this bargain price again. Each little bounce in the downtrend gives them hope the stock has made a low, only to be disappointed when the stock eventually cannot hold the temporary gains. Market psychology, support and resistance in the rearview mirror. It is not possible to know if the stock will find support and turn higher, or if the dip will turn into a larger, more serious bout of selling that leads to a reversal of the primary trend. We should wait for the odds to be in our favor when we purchase a stock. Would you rather guess a low or buy the stock when we know for fact that buyers have control? A buy above a flat to rising AVWAP gives us certainty that buyers are in control. When we purchase at potential support levels, areas of interest, the risk is that the support will not hold and there is not always a clear level to set our stops and limit any loss. We never know how far the price will continue to fall, which makes risk management a guessing game. A more professional approach is to wait for objective levels to form on the chart. Buy strength after the dip. We should view a price pullback to a level of interest as a potential opportunity on the chart, not a place to buy the stock. This area of interest guides us to look for a shorter time frame for evidence that buyers have regained control. Don't short the rip. Stocks in a downtrend are just the opposite. We hear people say, "Sell the rip" in a stock in a downtrend. The problem is what constitutes enough of a rip to sell short, and where to set the stop to protect against large rallies and resulting losses. We examined this in Chart 7.3. Chart 7.3 shows the danger of selling the stock short too early. Where would you have shorted the strength of that stock as it rallied? Would you sell at 11% in Area 1, the 14% rally in Area 2, or the 17% rally in Area 3? It is safer to short after the peak and the stock breaks below the AVWAP of those rallies, red dots. When we short with the downward momentum in our favor, we reduce the price risk because we have a safe place for our stop, above the most recent lower high. This approach helps us leverage time because we do not have to guess when the sellers have taken back control. Breakout trades. Stocks that break out of narrow price ranges can provide some of the most dynamic price moves. It is wise for traders to look for stocks that are near a breakout level and then monitor those stocks on shorter timeframes for clues that they might be close to their own respective momentum moves. It is quite satisfying and profitable to buy a stock right at the start of a new trend and hold it for large gains as the trend remains intact. This is the goal of trend trades. Defining a breakout. There are many versions of a breakout. Typically, it refers to a move to a new high in the time frame we are analyzing the stock. Many of us learn to buy the breakout, but what is a breakout really? If a stock rallied 10+% in 4 days, is it a good breakout? Always remember to answer these two questions: where it has come from, and where does it have the potential to go? Don't paint all breakouts with the same brush. The break past a narrow price range can offer a great opportunity for trend continuation. We can buy those stocks, but, as always, with a stop set in case the trend reverses. Many times I observe people on social media referring to a breakout in a stock that, technically, has already made a higher high. They don't understand that the quality of the breakout is riskier than it might appear. Narrow price ranges produce higher quality breakouts. Riskier breakouts typically emerge after the stock has made a large percentage prior move. It is a matter of, where has the stock come from? If it has used a lot of energy to get to the point of breakout, it will be more difficult to keep risk to a minimum. Charts 7.4 and 7.5 show different stocks on daily charts, and breakouts with different risk parameters. The stock in chart 7.4 shows the type of stock we want to buy on a breakout. This is a low-risk entry point because it comes from consolidation out of a tight range. The green dot near $72.50 was a good entry because the stock had spent little energy prior to the breakout point. Chart 7.5 shows another stock with two different purchase points in green ovals. When the stock crossed above the purple AVWAP from the prior high 1, we knew that the average long participant was profitable, and the average short seller was in a losing position. This is where buyers took control and is the optimal place for a low-risk purchase. We did not know if the buyers would remain in control, so we would set a stop just below the gap near $27 too. As the stock progressed higher, we would raise the stop under the successive higher lows, green arrows, and might have gotten stopped out near $29.73 3. The second entry, 4, shows the breakout to the new high. A purchase there would have been made at $29.75. The breakout, 4, is higher risk because the stock had already made a large percentage move prior to that entry. Those who purchased on the breakout, 4, arrived late to the trend compared to the buyers above the purple AVWAP anchored 1. The difference between these two purchases was a profit of approximately 9%, purchase at 1 to stop at 3, and a break-even trade, purchase at 4 and stop at 3. It is often taught that you should place an initial protective stop based on a fixed percentage, 3% or 5%, from the entry point. Although better than no stop strategy, the best approach is to set stops based on the definition of trend. When we buy a stock as it breaks past a near-term resistance level, 1, and the stock is in alignment with the larger timeframe trend, we want to place our stop below the most recent and relevant higher low. If it breaks that low, that is, the price drops below that low, the emerging trend has failed because the definition of the uptrend, higher highs and higher lows, no longer exists. Why would you want to continue to hold that stock? Get the entry right. The ability to hold a winning trade is largely a function of where you enter the stock. Are you in a position of strength or weakness from the start? Success is often simply the difference between a well-planned and executed trade at a strong, analytically supported, entry point, and a weak, emotionally determined, entry point. And guess what? That really is the difference between a professionally executed trade versus an amateurish entry. The number one consideration when you make a purchase is where your stop will go. If you are wrong, you want to be able to limit your loss. The closer the stop is to your entry, the more shares you can trade, which magnifies the upside potential. Advantage of the AVWAP entry versus buying dips and breakouts. Chart 7.6 labels 5 different moves. In each of these 5 pullbacks, dips, there are several choices where to enter a long position. We review the pros and cons of each of 3 different entry techniques below. In chart 7.6, the red highlighted areas show pullbacks, A. Green dots B. Show buy points where the relevant AVWAP is crossed, and the black arrows C. Show traditional breakout purchases. Entry A. The red shaded areas show where a pullback buyer would look to make a purchase. As we know, it is a guessing game to buy the low in the stock as the decline is underway. This entry does not protect us against a potential reversal into a longer-term downtrend, which could result in large losses. Entry B. The green dots show the ideal point to enter the stock as it crossed above the AVWAP from the prior peak. This is where we know with certainty the buyers have regained control from the previous high. A purchase here assures us that momentum is in our favor, and we also have a logical place for our stop, underneath the pullback low. This is called the AVWAP cross purchase. Entry C is the traditional breakout buy as the price makes a new high. As you can see, the breakout points come much later than the AVWAP cross purchase buyers. As an example, the first AVWAP cross purchase was at $6.50 versus the breakout buy of $7.74. Not only was the AVWAP cross purchase $1.24 or 19% lower than the breakout buy, the stop could have been tighter, less cents per share, than the breakout purchase. Study the other purchase areas at the green dots to compare the advantage of the AVWAP cross purchase to the other entry, pullback and breakout techniques. Advantage of the AVWAP entry versus shorting rips and breakdowns. Chart 7.7 labels 5 different moves. In each of these 5 rallies, rips, there are several choices where to enter a short position. We review the pros and cons of each of 3 different entry techniques below. The red highlighted areas, A, show counter-trend rallies in the overall downtrends. The green dots, B, show short sale points where the price crossed below the relevant AVWAP, and the labels, C, show traditional short sale breakdown to new lows sales. Entry A. The red shaded areas show where a short seller on a rally, rip, would look to enter a short position. As we know, it is a guessing game to short the high in the stock as the rally is underway. This entry does not protect us against a potential reversal higher, which could result in large losses. Entry B. The green dots show the ideal point to enter the stock as it crossed down below the AVWAP from the prior low. This is where we know with certainty the sellers have regained control from the previous low. A short sale here assures us that momentum is in our favor, and we also have a logical place for our stop, above the rally high. This is called the AVWAP cross short sale. Entry C is the traditional breakdown short sale as the price makes a new low. As you can see, the breakdown points come much later than the AVWAP cross sellers. As an example, the first AVWAP cross short sale was at $160.50 versus the breakdown sale of $140.45. Not only was the AVWAP cross short sale $20.05, or 14.3% higher than the breakdown sale, but the stop could have been tighter, less cents per share, than the breakdown short. Study the other short sale areas at the green dots to compare the advantage of the AVWAP cross short sale to the other entry techniques. Market psychology. Why breakouts and breakdowns fail. Breakouts. As we know, the markets discount the past and anticipate what is to come. Large stockholders who accumulate stock at lower prices often sell a portion of their stock on the breakout if the stock experienced a run-up prior to the break higher. Breakdowns. In a downtrend, short sellers will cover a portion of their bearish bets when the stock breaks to a new low when the stock already experienced a large move lower in the days prior to the breakdown. There is a phrase, "Sell or cover when you can, not when you have to." Smart money holders take advantage of the liquidity provided by the breakout chasers, people who buy when a stock makes a new short-term high after a large percentage move, and take profits on a portion of their position. This increased selling activity can result in the failure of a breakout in the near term. Be careful not to chase breakouts. Make the smarter entry when price crosses the key AVWAP so you can be in ahead of the crowd and with less risk. When you are involved in the stock before the crowd, it is a good idea to cash out a portion of your position as the breakout occurs. We want to trim a portion of the trade on strength and trail our stop with or in the direction of trend, raise it up under the new higher lows. This is where you may have heard the phrase, trim and trail. Risk management, our constant focus on where a stock has come from prior to our entry, helps us determine whether a breakout trade is considered low or high risk. If a stock had a strong move prior to a breakout, it is less likely it will continue. We compensate for the higher risk with smaller trade size. When we initiate our trade at the onset of fresh momentum, this puts the stock in alignment with the longer, more powerful trend, and we avoid the risk of time waiting for the move to happen. We also minimize the price risk and avoid unnecessary initial losses as the stock is in corrective mode.